Hey, welcome back. It's Joshua Bellinger of CounterVest. And before I share the trade that I have for you today, what I want you to do is I want you to like the video or dislike it if you, whatever you choose. Make sure you subscribe if you haven't. Share it with a friend. And at the end of the video, if you're on YouTube, leave a comment. Let me know what you think. So let's take a look here at Bumble Incorporated. So we often discuss in many other videos, and if this is your first time here, welcome. We never trade earnings uh, unless we know the risk. And we don't trade earnings specifically, just naked calls, but we avoid earnings, playing earning announcements. There's no edge. Now, if you want to gamble, you can gamble. That's fine. But we could play it into and we could play it after. So this is an after earnings trade, post earnings, and this is what's showing up on my system and why it's interesting. We're going to discuss it here. So we had a little bit of a price move. We got a little shake and bake here. It got sold off, bounced up. Buyers come in here, and earnings were better than expected. They had better forecasting, and forward guidance. Forward guidance. But anyways, this is a recent IPO. It IPO'd at 84, and it took a poop all the way down to 38, and now we're seeing it kind of firm up here. So this is interesting overall when we take a look here, is because there's not much price history before, but what I do see here is, okay, well, we have a floor that's building here. This is no different than when I saw on Facebook and other names that typically come out too high, sell off. You have the underwriters build a floor under it. You get buyers in there as well. And this is what we're seeing here. So we have some forward guidance here. We have some reaction. And we got earnings out of the way, firmed up, and we see it a move higher. The other reason why it's on my system is because today after earnings, there was some money. The reason why we care about money is because that's where money's going, and that's where money is betting on price direction. We don't want to be in stocks that are nothing's going on. We want to be in stocks when they're moving and when people are betting that they will move. So in the afternoon here, people are coming into these August 55. So they're buying these, and they're buying them around 75 cents. And we'll have to see what open interest is. And this is interesting. Now, most people will get stuck here and say, I'm going to buy these. Now, that's what we want to avoid. We want to create a thesis. We want to create where activity is happening, but we want to create a trade structure that benefits us and puts us in an opportunity to make money. Now, 8 days to expire here. They're buying the 75s, meaning that they're risking, they're buying at 75 cents-ish, meaning that they're risking 75 cents per contract for a trade that has a probability of expiring out of the money by 75%. Let's take a look at the delta there. So it would need another $4 to move, and it needs to do that in 8 days. And 2 of those days, 2 days, are the weekend. And then when we start to get into the, and then a Friday that expires, it really only at that point has five trading days, if that. So this move will have to happen within tomorrow or Monday, latest Tuesday. So they're looking for a quick move here. If they're buying, which I do show that they were buying, it just depends on how many are going to add to the open interest. But anyways, what I take from this is, okay, we have some positioning here. We have that risk out of the way. What could we do here? What's the trade? Well, one of the trades I like to do is a post-earnings trade. And this was on the system because it's a post-earnings, comes up tomorrow, and also firmed up. How am I going to do this? I'm going to fade the move here. Now, there's 2 ways to look at this. You could say, Josh, I don't really want to do what you're going to do, which I'll show you in a second. I'm going to do this way. And I want to show you this way because I just want to show you different ways to do it. You have 36 days if we go out to September. That's what I would be looking for. And if we just had purchased the 50, 55, because I don't want to get long just calls here. You could because you have that risk out of the way, but still, if we take a look here, volatility did take a nosedive down, but it still could come in a little bit more as well. So I would consider that as well. Taking a look here at the overall volatility, implied volatility, it did drop down, and that's good. And we have some opportunity for it to move higher, but as it continues to move higher here, we will see that continue to move lower, that volatility. So I want to offset that. Also, if this does take time, I don't want that to eat away at my nut. I want something to cover that. So what I would do is, because this has an $8 price to move here, going into the next 36 days, I would look, if I were to do a spread here, or if I were to do buy, sell, or something, the basic one, the simplest form is just to buy a call, sell the other. So this is a purchase here, and then this is going to be a sell here. That's a 50-60, $3 spread here. You have 83 cents of intrinsic value, and then you have the rest extrinsic. Most upside on this is $7, so you risk $3 to possibly make 7. Getting up to 60 on this one in the next 36 days. Touching that has a 44% probability. Touching it, so there's a 44% probability, less than a coin flip. You know, that's that's that. Now, what I am looking to do tomorrow is either to do a put spread in the 45. Got to clear this out. Either the 45, and we're going to hit the bid here, hit the offer there, short spread here, 45, 45.40, depending on what I can get tomorrow. I want a little bit more meat here, and that's the difficulty when you have strikes that are 5 points wide. So this is the kind of the problem that you fall into, is that you want enough of the move, but you don't want too much risk. And we have 5-point spreads. It makes it a little bit more difficult here. So what you'd be risking on this one is you're risking $4. That's what I would be looking for, to risk $4 to make $1. And I wouldn't be looking to make the whole dollar. So I would be looking to manage this probably at 50%, not probably, usually at 50%. Some people do 60%, some people do 40%. Whatever you do, you want to keep it consistent. There's no rule of thumb. Just got to pick one. Doesn't matter. You got to pick something though. You don't want to milk this all the way to, you know, trying to get everything out of it is just going to be, it's too much risk as time ticks away, and it's not what you want. You either then would roll it to something else, but that we're getting, you know, we're getting to options education at this point. Anyways, what I would be looking to do though is probably get a little aggressive here. If I'm bullish, I see this money here, and reaction's positive. Buyers come in here, firms up. I'm looking to hit the bid here and offer there, and $1.90. If I could get $2 on this, this is ideal. So on this one, I'm risking $2 to, or I'm risking $3 to make $2. So I take in the $2 here. If I got it at $2, so just move it up there. Now I'm risking $3. Now if we recall on that spread, we're risking $3 to make 7, but the probabilities are different. This one, we have a higher chance of probability of making profit versus the other way. So you're still risking $3. It depends on what risk that you want, and that's the interesting thing about trading options, and also the wonderful thing, because you could pick your risk, you could pick your poison, and sometimes you want to get aggressive, and sometimes you don't. If you're aggressive, you want to take that, and you are, you know, directionally biased. But if you're not, and you just are looking for, you know, possibly directional bias or just to stay at that level, this chips away, and there's 2 different ways. So there's always, you know, there's always a trade. It's just how you want to trade it. So there's 2 different trades here, or 3 different trades. That's how I would do it. Whatever the risk that you're looking to do, understand how that risk is, position it, and then manage that risk. So on this one, I'd be looking to take off at $1. Get $1 out of here, take $1, and if I got it within a day, boom, out of it. So I wouldn't be looking to hold this one for a long time. Decay, take the money, and run. That's what I'm looking at. So that's a post-earnings trade. That's how to trade options, and there's many more ways to trade it. So make sure you keep following the channel. We'll cover more opportunities and more ways to trade. Hopefully you learned a thing or two. I'll see you in the next video.